Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Are you ready to die? Because if you're ready to die, I have the report you need, the 7 mistakes that people make for end-of-life planning. It's estate planning. It's the don'ts of estate planning, and they've actually got a couple really good ideas. And Vanguard now is saying you need to buy TIPS, the Treasury Inflation Protected Securities. Vanguard's giving advice now? I thought they were just a custodian. Anyway, if you think inflation's coming down, that's the worst time to buy TIPS. And by the way, TIPS lag anyway by a whole year, the adjustment for inflation. So you ought to run. There's usually a lot better ways than Treasury inflation protected securities. And the fiduciary rule got passed with an exception for the salespeople. Remember, I told you folks. So what was the point? What was the point of all that if you just threw in an exception? Just to make you feel good like they're doing something. Anyway, the lobbyist won, and they want to push that lifetime income. Here's the point. Don't be that guy. Don't do an annuity out of your 401k or your IRA. Don't be that person. And retail sales. What say you? There's a great article in the Mailbag. I put it in there. It's a little bit too heady for the show. It dives kind of deep in the good and data points in retail sales. But if you're a data junkie and you like doing economic and fundamental analysis, you might like that. But at Revere, price dictates anyway. So it's not really the retail sales, it's the reaction to retail sales that we care about. But the big item and the big article and topic, and this topic is going to be, you're going to hear this throughout the election year, inflation, interest rates, and the economy. And we're going to talk about that, good and bad. And I'm going to talk about this article, Are Higher Rates Here to Stay, by Paul Krugman. Krugman. Anyway, so very quickly, I'm going to hit these two, and then we're going to go to the markets. The 7 mistakes end-of-life planning, these mistakes you want to avoid. So many people, number one, they obsess over estate taxes. Folks, the estate exemption is high enough that unless you're worth millions and millions, you don't have a problem. And then even if you're worth millions, as long as you got a simple bypass clause in your will so both you and your spouse get your own exemption, it doesn't just go to the surviving spouse, so you only get one collectively, but you both get them. You really going to have over $12 million even when they sunset in 2026. So most clients worry about the estate tax when there really is none. You really got to worry about income tax, which leads me to the second one, not taking advantage of the final income tax return. That's because when you're married, you get 2 deductions, you get certain things. And so it's the last time you're going to file. After that, the surviving spouse is going to file an individual tax return with a different tax bracket. So you want to make sure that you push a few of those things through. Number 3, failing to use the step up in basis. Basically, the decedent gets a step up in basis. So if you buy a stock years ago at 30 and now it's at 100 and you die, that stock is now at 100 to the surviving people. So you have much less of a capital gain. Here's what people don't realize. One big mistake they do is they're on their deathbed, they want to be gracious to their kids, so they gift it to their kids. Now the child just inherited the stock at $30 a share, not $100. So if death is imminent, you actually want to, for the things that have a high step up in basis, you actually want to let them get that, which leads me to my next point that nobody talks about, and that's the step down in basis as well. So really, you want to go book the losses before you die to make sure that you can use them. And then you want the ones with the biggest gains to get a step up in basis. Not optimizing the proper titling of accounts. Now, in community property states like Texas, it doesn't really matter as much, but separate property versus community property states, those are different. And the titling in the such states, they get a different, depending on how you have it titled. So if you've got it titled on a joint account, only half of that account may get a step up in basis, whereas if it's 100% titled in that individual's name, then the entire account gets a step up in basis. So when you have a non-community property state, doing the titling matters. And by the way, for asset protection and things, so do revocable trusts sometimes. In a community property state, you'd have a joint revocable trust, but in separate property states, sometimes it's better to have two separate revocable trusts. And this, not harvesting losses before it's too late. I already mentioned that. In any event, it is a very good article. It is in the show notes if you want to read it. And folks, we don't talk about it here enough. I actually had a client, I helped them with estate planning and doing reviewing their revocable trust. And they said, you don't really talk about that on the show. I didn't realize I just thought you were kind of a money manager, an asset manager, and you manage your stuff. You don't really talk about the fact, folks, we're a holistic, full-service planning firm, a wealth management firm. We can help you with your wills, trust, estate, asset protection, corporate structure, retirement plans, estate. We do all that stuff. I've got a deep background in all that stuff. But the markets are a lot more fun. They're not boring. And so we normally talk about that, and that is a big part of our business. So in any event, we have that. Now, the main article and the main topic du jour before we hit the show notes. And by the way, this article is also in the show notes, and it was sent by MB, who happens to be a client. I think he knows that Paul Krugman kind of gets under my skin. He's a Keynesian economist versus an Austrian economist like me. If you don't know what those two are, look that up. But anyway, he just sent the article and that's it, no comment. I said, thanks for sending, interesting take. But we're nowhere near like the 90s, time permitting. I'll bring it up on the show. I couldn't pass it up. I had to bring it up. So we're going to talk about that right now. So Paul Krugman wrote this article. It says, higher rates are here to stay. And Paul Krugman is a Keynesian economist, like I said. He's a big proponent of modern monetary theory, MMT, which essentially says you can print as much money as you want and it won't cause inflation. That didn't age very well. He was pushing that bigly in 2018, 19, and until we opened up the doors and from COVID, and then we had massive inflation. Then that MMT theory got slaughtered, and so now everybody's trying to defend that. But very quickly, he said, do you remember the economy of the late 90s? You probably remember it's a time of prosperity and low unemployment, rapid growth, combined with low inflation marred by irrational exuberance. You might not realize how our economy of 24 resembles the late Clinton years. People may not be feeling the prosperity. At least they say they aren't feeling it. So now he's calling you a liar. By the way, Americans, a positive assessment of their own, they feel good about their own finances, but they're negative on the economy. But the numbers look pretty good. That's what he's saying. What about inflation? We did not have serious inflation until 21-22, but it's come way down since. And it's true, the past inflation reports were disappointing. In other words, the last 2 months, it actually showed that it's rearing its ugly head again. But for the most part, this probably reflects statistical noise. So it's not real inflation, it's just statistical. And he said that he likes to measure this. The Bank of New York has this underlying inflation that tries to filter out this noise. And he likes it because it's an algorithm untouched by human hands. Do these algorithms feel inflation, or is it the humans that feel inflation? See, I personally feel inflation. I don't care what the algorithms say. I know what my inflation is, Paul. Anyway, And by the way, they manipulate the data with the inflation, and they pick items that don't go up, and they manipulate it like the core is X food and energy. I eat and drive every day. I want food and energy in there. In any event, he said, but now he starts talking about housing. The interest rates he said interest rates, high interest rates. Would home buyers are feeling frustrated with high interest rates. Surprisingly, he said, is that a big difference from the 90s? No. Rates were this high during the 90s, and that didn't cause the housing to slow down. Paul, it's not the interest rates that are stopping people from buying homes. It's the huge valuations from when you took interest rates down to zero and artificially pumped up the prices of real assets, including stocks, by the way, but also housing prices. So when now, instead of getting an 8 or 9% mortgage rate on a $200,000 home, $200,000 just 10 years ago, it's now an $800,000 home or $600,000 home, depending on where you live. That's the problem. In any event, he said, while it might be a great comparison, he said, high interest rates might last a little longer. He thought they would come down. He said, people were predicting high rates would not last long, including me. I thought they would. It was a temporary phenomenon, and I expected them to come down. Paul, actually, this is the 30-year. We're close to the average long-term interest rates. The last 10 years was an anomaly. That's not the norm. If you have super low interest rates and you have very high inflation, if you have high inflation, which we still have, interest rates have to stay high because you got to be compensated. If the interest rate is below the inflation rate, you're losing money on that bond. You're losing money on that interest. It's all about purchasing power. So you've got to add that interest inflation component to cover that. So if inflation is 4 and your bond pays 6%, your real return is 2%. It's not 6%. The inflation ate up 4% of that. That's why interest rates are staying high. And then he started talking about the investment, the silliness of the .com investments, and he said, but there was a surging fiber optic build out that was much more important driver of the economy in the 90s. Paul, you got that one right. That was correct. Now he's talking about how AI and this new push may be this new driver of the economy. But he also said the huge surge in manufacturing, primarily driven by the Biden administration's climate policies, is really stimulated growth. There it is. He's defending the Biden. Seriously, he's defending this whole thing is about defending the Biden economics. And that's why I was talking about earlier, we're going to talk about inflation, economics, and interest rates, because all through this election year, you're going to hear the right say, stagflation, which a little bit of truth to that, or there's a fear that could come true. But stagflation, are we kind of slowing? Is the economy slowing? Which it is, and is inflation going to stay persistently sticky, which it seems to be doing? Is that going to be here to stay, or is that just transitory? Or on the other side,
that fiber optic build out in the 90s, was that for the internet that Krugman said was going to have no more of an impact on society than the fax machine?
That's exactly right. That's
okay.
exactly right. That's exactly right. But here's the point. And look, what he's saying is, first of all, he's trying to tie it to Clinton. Clinton actually wanted to raise taxes in the 90s, if you recall. But the Republicans actually, under Newt Gingrich, had a majority, a supermajority in the House and a majority in the Senate, and they were going to override. They came out with big tax cuts, and they were going to override Clinton's veto, and Clinton knew it. Clinton was a very sharp, smart politician. He actually signed it because he knew he was going to get it overridden anyway. He knew it was going to stimulate the economy and the economy would pick up, and Clinton took credit for it. He got the credit for that great economy when it probably should have been shared with the House and Senate, who really threatened to push it through. But I digress. By the way, while we're talking about it, when tax rates are lower, the Treasury actually brings in more revenue. So you can argue about bullets or babies, welfare or defense. That's a totally different argument. But if you want to bring in more revenue, lower tax rates are the way to go. By the way, there's no such thing as corporate tax rates. They pass it on to you, just like payroll or rent. If they can't pass it on to you, they go out of business and people are without work. But anyway, whole point is he's trying to tie this economy to the 90s. So, and you can read this article. So here's my thoughts. Paul, this is a political piece, not an economic piece. Do not be deceived, folks. He's making excuses for the economy and his types of policies. He wants to print, and it will not cause inflation. It's already caused inflation. Now he's kind of trying to backtrack. He's trying to cover. Now, first, rates, interest rates. Like I said, they're gonna stay higher because they have to cover the inflation rate. Now, the Fed can lower short-term rates, but the markets kind of determine the longer-term rates, and it's going to be harder for them to come down too much. Otherwise, you'll lose money. Second, we are actually near the long-term mean of interest rates. ZIRP, zero interest rate policy, was the anomaly, not the mean, not the norm. Okay? They started that after the 2008 economic crisis. And the problem is, once you take interest rates so low, then when you raise them, you have the opposite effect. Folks, compounding works both ways. The more you make, the quicker it compounds. The more you lose, the more you got to make up for the amount you lost. That's actually the same thing with rates. The further you take them down, the bigger the magnitude of just a 1% increase. And 1% increase from 1% level of rates is 100% increase. Whereas if you're at 3%, it's only a 33% increase. What I'm saying is that now, and also it has the effect. So when they lower rates, it kind of gooses the economy. It's like giving a steroid shot. It gives you a little bit of a boost. But is it really good for long-term health of the economy and the strength of your currency? A stable currency is probably better. But conversely, when you raise rates, it also has the negative headwind effect. So the question is, if rates stay high, is that too much of a headwind for stocks? Now, there's also another article in the show notes talking about actually stocks do pretty well during higher rates. That's counterintuitive, and I'm not going to bury the lead for you. The bottom line is what the study showed is usually when rates were below 3.5%, which is pretty damn low, the short-term rates, by the way, 3.5%, that meant the Fed was really trying to stimulate because the economy was in the toilet. We were in a recession. It was bad. And so they were trying to goose the economy. So they'd stimulate to try to goose. Now, the stock market would actually rally on the lower rates while you're still in recession because they were seeing us come out of the recession. So you got to separate Main Street from Wall Street. Point being, though, is when interest rates are real low, a lot of times the economy and the stock market is doing bad. That's why they drop rates, and then the stock market will start to recover before the economy recovers. And the article saying that above 3.5%, 4%, that means it's a pretty healthy economy, so the markets should do pretty well. That's actually counterintuitive. It's a great article. Anyway, then I've already mentioned that homeowners cannot, because he talks about housing and what could spur housing. The problem with housing is the valuations. What fixes housing? A slowdown in housing, like we're seeing now in the last month. The new numbers came out showing a slowdown. When rates drop, they'll become more affordable. But with zero interest rate policy, home prices skyrocketed. And that's the problem when you print money and drop rates to near zero. you distort economic reality and you cause inflation. So the only thing I agree with Paul in this article is we are returning to these levels not actually seen in a long time, but they're actually normal rates, normal levels, not high levels. I also agree that the economy was much well. I disagree with him that it's like the 90s or it might be coming up. He's trying to say, just wait, it's coming. Okay. In the 90s, we actually did have a strong economy, and some of it was left over from all the Reagan policies still pull in place. I do agree the economy is showing strength right now, some strength, not a lot, but some. It depends on the areas. But the government represents 30% of GDP now. It didn't represent 30, not even close to 30%. In fact, since Biden took over, it's almost doubled. So they're spending a lot of government spending to help support the economy. If you take out that part of it, a lot of sectors are in recession now. There are some sectors that are doing very well, which Don and the guys can talk about. But Paul, I disagree vehemently. We are not returning to the 90s. Well, unless we actually stop this madness and stop this crazy spending spree the government's on, and we actually start getting fiscally responsible. The reason for the 90s was actually fiscal responsibility, not printing till the cows come home. That's my take. Now, it doesn't matter what I think. I'm just one great-looking guy on a radio podcast called Your Money, because it's your money. It's not their money. It's not the government money, and it's not Wall Street's money. It's your money, but you've got to take your own responsibility for it because the government ain't going to help you. I love Reagan's words. The most dangerous word you can ever hear is, I'm from the government and I'm here to help. Folks, the only person that's going to help you is yourself and maybe those around you that understand this and do these things. So with that, let's go to the markets, because this market has really been a wild ride this past month. And a week ago, it looked like the sky was falling. And just a couple days ago, after a couple of decent earnings reports, now it looks like everything is starting to firm back up again. So Don, what is going on, and what are you and the team doing at Revere to navigate these markets?
Well, Dan, it has been quite a week, and it's not really just the earnings reports, although we're Friday at noon Eastern time as we're recording this, and the S&P 500 is up 1.1%. The NASDAQ 100 is up almost 2% because of the positive reaction to Apple's earnings report. And it wasn't so much that the numbers were great. Here you can see they had a 1% increase in earnings and a 4% decline in sales. It's that Cook spoke optimistically about the future. He normally doesn't. But more than that, a massive stock buyback and an increase in their dividend. And it's gapped up, gotten back above all the moving averages now, still in a base. But because of the big impact that Apple has on the indexes, that is leading to a nice move up in the Dow, in the S&P 500, and the NASDAQ 100. Go back to Wednesday and the S&P 500, and Wednesday was the big FOMC day. I'm going to bring up a 15-minute chart here. This was the crazy day on Wednesday when, while Powell was speaking, it was kind of a dovish speech, and the market took off to the upside. As soon as he stopped, all of the gains were given back, and we closed below where we actually were. The pivot point here was 50.24 when he started speaking. Then Thursday morning, after everybody that has money in their funds and economists worldwide and anybody that has an interest in monetary and or fiscal policy we had a gap up, and then immediately it sold off, and everybody at that point was like, oh my God, run for the hills. But all we did is undercut the prior day's low by 2 points and then immediately slingshot back to the upside for the rest of the day. Then this morning, or last night, we had Apple, so we were already going to open up around this area, 50.90. And then the employment data came out, and it was weak. It's counterintuitive, but right now, a weakening economy is leading to the conclusion that the Fed is going to cut rates sooner, and that led to a gap up. And so far, we're holding this gap as of noon on Friday, again, as I said. So really, we're hanging right now around this 51.23, 20 to 23 level, which is the high from Monday when we initially gapped up. We sold off Monday into the close. We gapped up on Tuesday and sold off hard all day. And that was seen as everybody seemed pretty hawkish going into the FOMC meeting because of the increasing inflationary numbers that had been coming out. But Powell, and in fact, some talk of a rate hike, they asked him about that, and he said that that's absolutely not something they're considering, was a rate hike. And then people asked him about stagflation because we're seeing a slowing economy but sticky inflation. And he talked back to when that term was used in the 70s and how stagnant the economy was and how inflationary it was. And he uttered a pretty classic line. He said, "I don't see the stag or the flation." And the market liked that while he was speaking. But then, as I said, it sold off into the close and set up everybody thinking we were going to go lower. But the market seeks to confuse the masses. And then we ran up after the move down on Thursday, and now we're holding the gap. So take a step back, and where are we on the big picture? And really, we've been consolidating in this 5,000 to 5120 area, and we're right at the top of it. It puts us back above this green line, the declining 21-day moving average, which is actually no longer declining. It's flattening out and starting to move higher. And it puts us right at this red line, the 50-day moving average, which has been acting as resistance. It was resistance earlier in the week when we got to it, and it's acting as resistance right now. So if you're a bull, you want to see us break through this and close maybe up around 51.40, 51.50 to clear that level decisively. And then next week, if we back test that level, hold it, bounce off of it, at a worst come down to 5,100, but also hold the 21-day moving average, which is going to be starting to turn up. Hold that, and then rally off of that. May is, that old sell in May and go away has not really been accurate in recent history. It's more that May is okay, but you want to sell in June before the swoon, if I can coin that phrase. But so that's where we are right now. We're back to the top of the range. Leaders improving in their action, but certainly not out of the woods, as there is quite a bit of overhead resistance right here above this 5120-ish level. So bulls want to see us clear that. NASDAQ 100 certainly benefiting from Apple, but it's right into the 50-day moving average there as well. For the most part, stocks, like I said, acting well, holding their gains today. There have been a couple of earnings blow-ups, but for the most part, the behavior is, if you were bearish, you would have wanted to see this gap up fail immediately. And I saw a lot of bears on Twitter saying that that's what they were expecting. And, we've got over 3.5 hours of trading left. It may fail by the end of the day, but as of right now, it's put in a low and is rallying off that. As long as we hold that low, which is above the 21-day moving average, that's certainly a step in the right direction. As people that follow us know, we use that as our short-term trend indicator. We want to be above that level, and we want to see that sloping higher. We also want to see that level get above the 50-day moving average, and we're about a week away from that, depending on the action next week, if it maintains its bullish posture. And then you got the 21 above the 50, above the 100, above the 150, and above the 200, and all of the moving averages are stacked bullishly. Then you take a step back and you say, how are leading growth stocks acting? And we look at the leading stocks in the leading sectors at that point and work our way into them at low risk entry points.
All right. Listen, so folks, you've got Powell being, even though they said he was dovish, to me, it felt a little more, he was trying to put a softer tone and trying to dial down his hawkishness. I actually thought basically he said, look, probably rates are off the table for a while and we'll see. But it felt hawkish to me. Rates are a little bit of a headwind, but the thing that you've got to realize, and I said this on the show a month ago, you can go back to the old podcast, that buybacks were going to dry up before earnings season because they go in their blackout period. The month before their particular company reports earnings, they go into a blackout period and they got to halt their buybacks. Then once they report, they can start their buybacks again, which, like Don said, is what Apple announced. So their earnings weren't great. They just announced they're going to buy a buttload of their stock back. That's the reason Apple's rallying. But here's the other point. There's lots of companies that are going to, all of a sudden, their handcuffs are going to be removed and they're going to be able to have buybacks. So even if the overall economy or market sentiment might be negative, don't underestimate the power of buybacks. That's going to be really kind of the wild card. But that's why at Revere, it doesn't matter what Don thinks or what I think. It's what the market thinks, and price is truth. So if the buybacks trump the economic conditions or the interest rates or the inflation or whatever negative thing that you want to put on it, will that overcome it, or will the negativity overcome it? A lot of our research actually measures what the investors are doing, the buying and selling volume, and the reaction to all this data, not the data itself. The data itself is for forecasters. And guess what? They are wrong just as much as they're right. All right, Don, what does the team have?
Boy, Dan, that buyback, you've been on that for a couple of weeks. You might have lost some weight, but your brain is just as big as ever, isn't it?
Oh, huge.
Okay. Let's go to Connor first today. He is going to talk about a possibly emerging theme in the market. Connor, take it away.
Yep. Thanks, Don. Yeah. So today I wanted to talk about China and a clear character change in the price action for this group. And before we start, if you've read the financial media, you've seen articles, China is one of the most hated areas of the market. And, you see articles coming out left and right every day just about how, you can't invest in China stocks and it's a horrible market to be involved in. But I put together a year-to-date performance chart, and as of yesterday, KWeb's outperforming the S&P 500, the NASDAQ, the Russell, the Dow. So when you look at it from that angle on a performance basis, it's actually outperforming the US markets, and that's with all the negative sentiment headlines. So I thought that was interesting. And if we dive into the charts, Don, if you pull up a chart of KWeb.
KWeb is an ETF that focuses on U.S. listed China internet companies.
Yes. So this is
okay.
Yes, correct. This is what would be like the NASDAQ for China, and kind of what I like to look at when analyzing this market. But when you look at this chart, I mean, it looks bad. It's been in a stage 4 downtrend for over a year. But when you look at that March 14th week, there was capitulation volume, and you can see that was the highest volume in over a year. And then price danced around that level, held. And we've talked about stage analysis before, and then you can see it's building higher lows and it's going sideways. So bottomings are always a process. It's not just you hit that low and go straight up. You need to get rid of some of those sellers. Buyers have to come in. And this started to build higher lows, shakeouts here and there, and all those moving averages started to get converged. And Don's pointing out the RS line started to make higher lows as well. And as you can see this week, or the week before, a huge break above the 200-day moving average on volume, and it's followed through to the upside ever since. And if you go to a weekly chart, for our stage analysis, we use the 10, 30, and 40-week moving average. and this is clearing all of those averages. There is still some resistance on the left side of the chart, obviously, after that huge decline. But when you see volume, you see those blue bars coming in and clearing all those moving averages, price action is telling you that, hey, potentially this is done going down and it wants to resume an uptrend. And from our studies, the best time to be in the market in stocks or specific sectors is the stage 2 uptrend. Because look, if you tried to time the bottom in this stage 1 base, so much headaches and opportunity cost of capital. But now starting to see the green light, volume coming in, breaking above these moving averages, and coming out of a well-established base. So clear change in character there. And then now if we look at some of the individual names, PDD, this is one of the China leaders. And yesterday, if you go to a daily chart, Don, yesterday this was up 10% on 150% above average volume. And you can see this was showing subtle signs of bottoming. It had that nasty gap down on earnings, and we were watching this stock and then took it off our radar. But it put in a double bottom off that 200-day moving average, and the RS line showed a slight positive divergence, putting in a higher low. And then yesterday, like I mentioned, huge day on huge volume, and it's holding those gains today. So this is one to watch moving forward. And obviously we know China stocks, they carry more risk per se, but when you look at PDD, it's got a 99 composite rating, 77 EPS rating, up-down volume of 1.2, along with some solid earnings and sales. So that's good to see in this one. And to me, PDD is one of the leaders in this Chinese stock area. And then if you go to Futu, Don, this is another one.
They also have the that Temu website that is getting a lot of traction in the U.S. PDD. I'm talking about a lot of. I can't go to any page on the internet without having Temu ads pop up on it.
Yeah, no, they got it's. I think a lot of people like it. It's pretty cheap and stuff.
Right, you got that right.
Yeah, yep. Especially
counterfeit in some cases.
Yeah.
Yeah.
Look, I'll be honest. I can't stand Temu. My daughter ordered a couple things, and I banned her from buying anything from there anymore. Anyway.
Big bully.
Yep.
And then second name I wanted to talk about is Futu. Now they offer like an online brokerage program and platform. And I mentioned on the podcast, I think a couple weeks ago, or I just posted on Twitter, is some of these brokerage stocks are acting really good. So maybe that transpires into this name because you've seen strong action from Interactive Brokers, Robinhood's trading all right. But yeah, so if you look at this chart, this had, similar volume characteristics. On the 23rd, it had a huge pocket pivot gap up above all key moving averages. And then, kind of digested a little bit. And then just yesterday, it had that another massive gap up on volume. And today's putting in a tight inside day. Clearly some resistance around the 67 level. But as you can see, price is holding above now. And if you look at if you go to the weekly chart, Don, this is a really nice weekly chart. Clear defined downtrend line that it's breaking out from. Many characteristics of a stage 1 breakout into a stage 2 uptrend. Price is back above 10, 30, 40 week moving average. And when looking at these stage 1 bottoms, you want to see a lot of back and forth in the stage 1 base. You want to see like people get worn out of the stock. They just kind of give up on the thing. And that's usually precisely when it's going to start breaking out. And the last 2 weeks of volume have been above average volume. And just looking at the fundamentals, 95 comp rating, 1.6 up down volume, which is really strong number. And then earnings and sales are relatively solid. So these are the two from scanning and two of the stronger names in the area, and just a sector to watch. And like I showed at the beginning, it is quite interesting to see KWeb outperforming all the US indexes. So something to keep an eye on moving forward.
As far as, well, a couple things. First of all, if you just covered up the chart or the name on the chart and just looked at the chart, you'd be like, yeah, I'm buying this. Yes, it's a Chinese company, and the government does have their boot on the neck of the companies over there, and you never know what they're going to come out with. So size appropriately. But as far as talking about people all getting worn out, this has made a couple of attempts to come out of a bottom before and get back above the 150 and the 200-day moving averages. Here's one, here's another, here's a third, and every time it failed. So the market likes to fool the masses. And if you thought is the fourth time a charm here, I don't know if it is. We don't ever know if it is, but we do know that we've got to stop if it doesn't work out. So, but the relative strength is confirming the price as well. That's on Futu, back to the weekly of PDD. And, this looks even better. And it does have that American sales component to it. The other one, a brokerage, do you trust the Chinese accounting on them? I know
No.
I don't. But KWeb, the ETF, KWeb, coming out of that bottoming base as well, is a conglomeration of sites like Baidu, JD.com, a bunch of the bigger, well-known Chinese names that are already listed on the U.S. So that's the diversified way to play it, is with KWeb. Great stuff, Connor. Appreciate that.
Yep.
Let's go over to Ted now. Ted's got 4 charts to take us through, and he's going to talk about earnings gaps, episodic pivots.
Yeah. So one of the greatest opportunities in the market for asymmetric returns are specifically earnings-related episodic pivots. And on the screen, I just listed some of my criteria. I called this like the model book. So if it checks every single box, I mean, you're like the conviction is the highest, but it doesn't have to check every single one of these boxes. And I'll kind of walk you through which one must be met. So the first one pretty much has to be met every time. A big surprise or guidance raise and or strong earnings and revenues. So sometimes you might not have the earnings, but you'll have really strong revenues, but you'll still get that big surprise where they forecast huge earnings in the future. And actually NVIDIA, when you look back, that's kind of when it started. The earnings weren't on the table yet, but they raised guidance tremendously. And eventually the price action, eventually the earnings caught up to the price action, which preceded it. The second one, for me, I kind of have a minimum 8 to 10% plus gap out of a neglected clean range. So it's not some stock that's been trending for months and months on end, making like 100, 200% move. I ideally want it to come out of a base, preferably into 52-week highs, and the best are into all-time highs. 3 through 5 are more they're more just like a bonus, but I do like to see all 3 through 5 as well, which is a lower market cap. Like a gap up on a $500 billion market cap company is probably not going to give you the 50 to 100% gains within 1 to 3 months. So more of that mid cap and smaller large cap. And if you have a smaller account, even the smaller cap territories are the best for episodic pivots. And then lower float as well, because when there's a lower float and great demand, those prices can really be pushed higher. Fourth one, medium to high short interest. When you have a lot of shorts trapped on a surprise, they're scrambling to cover. So that just adds to the buying pressure. And then the fifth one is multiple analysts that raise price targets. And then extra, just IPO'd within the last 10 years. There are many studies that show that more recent companies, newer companies, are the stocks that make the biggest moves within a shorter period of time. And then finally, a strong theme or group. So those are extras. And if you go into the next chart I have, Don, I just want to walk the audience through kind of how I find these in my daily process. I use a site called MarketChameleon, and it's totally free. I use it for free too. You can pay for it for other features, but The free version is really all you need. And if you look at the middle screen, the middle box, those are the gainers in pre-market. So every pre-market, I filter the top gainers by percent change, and I just quickly scan through them. And what's nice about MarketChameleon that I haven't found on other sites or services is that on the very right side, you see alerts with an E and an N. And so E obviously symbolizes earnings and N symbolizes news. And so I quickly look at those and hone in on the ones that have an E because I want to see those earnings. And those are often the best episodic pivots. So the example I want to show you is a recent one that I actually bought. The reason we couldn't buy it for Grow and clients yet is because it still wasn't at our threshold for liquidity. But now with the volume coming in on earnings day, it surpassed that $100 million average daily volume. So now we're definitely tracking it closely to see if it pulls back and forms a continuation pivot. And so I tweeted it out, pretty much a checklist I showed before. It had extraordinary earnings, massive earnings surprise of 800% on pretty much 538% year over year growth. And it was the second quarter of earnings acceleration. There was 4 analysts that revised their targets higher. At the same time, there's big sales and surprise. Triple digits year over year sales growth on 16% surprise. And when you look back, there's 9 quarters in a row of triple digit sales, which is just, I haven't really seen that in a company recently. And then they revised their 4-year revenues higher as well versus prior estimates. And then TMDX, I have a monthly chart right here, but we'll talk about the charts more specifically in the next slide. It was a huge neglected base. It came out of a 9-month stage 1 base, breaking into new all-time highs, which just made it even better. And then it's a lower market cap at $3 billion and lower float with 32 million shares. And the short interest was huge as well at 20% short interest. And the stock IPO within the last 10 years, and specifically within the last 5 years. So pretty much checked every single one of my boxes. Don, if you could bring up the next chart, it's
Ted,
daily and weekly. Yeah.
Ted, can you explain to the because I mean obviously you and I know what it is. Hey, tell the listener what the float is. They may not. Some people may not know what the float is.
The float is just the available shares on the market for trading.
Right. So folks, you can have so many shares issued and outstanding, but the company or a few people that aren't going to trade, or they could be treasury stock, it's stock, but the float is the one available in the open market for sale. So if it's a low float number, that means there's less shares available. There's less quantity, right? So it's supply and demand. There's less supply. So if there's less supply and you've got strong demand, that pushes up price. All right, go ahead, Ted.
Yeah. And just talking about that supply and demand equation, I like the reason why these setups are so powerful is that you have a demand shock catalyzed by a news event. And what Dan just said, when there's that lower float, lower supply, and there's just this sudden demand shock, you can get really quick rising prices. And that's what we want to get on. And then Don has the daily and weekly chart of TMDX on the screen now. And I drew in the range that I was talking about, the neglected range, just a 9-month clean range that it broke out of into all-time highs. And finally, Don will pull it up on MarketSmith. And for those that use MarketSmith, you pretty much can get all the data that you need for identifying the best earnings episodic pivots. So yeah, here it is. And Don, can you point to the market cap and float? That's around like the mid top area of the screen. So the moment I find a gapper on earnings that's showing great numbers, I go to MarketSmith or DeepView if you use that as well. And I look at the market cap and float. Those check the boxes. If you go left a little bit, Don, right now it says there's still short interest. I can't read that. Is that 6.5 days? 11% short interest that must be covered within 6.5 days. That was at 20% before. So some shorts have covered, and there's still more shorts that are thinking about whether they want to cover or not. And after the recent price action, I mean, if I was a short, I'd probably be looking to cover as well. Next, Don, can you point towards the yearly figures for earnings? You can see that that enormous 2024 and 2025 estimate. And what I refer to that is called like for me, I call it an earnings breakout, because if you look at the prior years, they're all negative numbers, and now we're dipping into that positive territory, and it's accelerating. And then Don also drew in a line at the quarterly earnings and revenues as well. And even another bonus was that the funds is in that 400 to 500 range, which we found to be like the sweet spot for big movers. That 400 to 500 fund range into the thousands range as the funds accumulate the stock in its move. And then, yeah, actually, MarketSmith also shows the IPO date as well, just right under float. So as you can see, MarketSmith is very comprehensive and gives you everything you need to succeed in these earnings episodic pivots. And we definitely track these closely.
Great stuff, Ted. Also, on the weekly, it's they add this green line which tracks the growth of earnings, and they had a little bit of a stumble here back in 2023, but you can see this green line here. Their earnings at an all-time high, and prices just confirming that. So, very important. We're not just chartists here. We the fundamentals, as O'Neill said, it's not the chart that makes the stock go higher. It's the story behind the chart. And that's anybody that doesn't factor in what a company's doing. To us, the two main letters in CAN-SLIM are the M, meaning the market has to be in your favor, and that means the company has some sort of a new product, new service, or there's new economic conditions, a new CEO, something new about the company that's going to make it outperform. And this is a perfect example of what happens when all those things come together.
Yep.
Dan, that's it from the tech side today. You can take us home.
Listen, thanks, Ted and Connor. And folks, I'm going to actually try to coax Ted and Connor, time permitting. They're very busy managing and with Don managing the client portfolios, but time permitting over the next couple of weeks, I'm going to see if I can't have them kind of create a short video that we can post on YouTube or the website. And at Revere University, we kind of got like a little area that kind of gives some ideas, portfolio management, sell rules, buy rules, whatever. I'm going to actually see if I can't get them to do their process of selecting stuff, like how Ted, what he just went over, do a short video on how he screens for, finds these gappers or these growths, how he's finding these stocks. And I'll have Ted and Connor each do one. They're slightly different, their methodology, but they're similar, obviously, because there's a lot of overlapping things. You want to look for increasing volume, increasing accumulation, revenue growth, all that kind of stuff. So if a chart looks good with one technical indicator, it's going to look good in other technical indicators. So even if they're doing slightly different, using different tools, these same stocks, these leading stocks will pop up on a bunch of different charts. And anyway, stay tuned. All right, very quickly, I did want to go over the mailbag. I did forget the mailbag. And this is actually from someone that sent me an email on 51MR, and she's talking about she's an active person, manages her own stuff, but she's got her mother. She doesn't want to be responsible on it. Her mom's elderly. She said, Mom's assets are mostly a taxable account. With Grotection strategy, wouldn't her gains be subject to short-term capital gains rate? If so, isn't that going to eat into her performance? Me, great question. Yes, it will mostly be short-term capital gains, but during a strong uptrend, you will get some long-term capital gains. You can either pay the tax and control your own destiny, or simply let the account go down in value and deal with negative 30% plus drops, meaning losing 30% or more every 3 to 5 years. but we also harvest losses as we go. So the tax consequences aren't going to be nearly as bad as you think in your head. Okay. Especially at your mom's assumed tax rate. She's retired, living on Social Security, small pension, whatever. So even with the taxes, it is still a great strategy protecting the downside. And at your mom's, again, assumed tax rate, it's probably not that much different than the long-term capital gains rate. Folks, until you're making a lot of money, mid six figures, you're not going to be at the 32 or 34% rate. You're going to be at the 22 or 24% rate. So long-term capital gains are at 20%. There's not as big a differential until you get in the higher income levels. Okay. Now I said in 1999, when I was working for another firm, we made 42% for our clients. S&P was up 32%, but we did better. I said early in December, I went into all the taxable accounts and booked all the material losses. So the clients ended up only paying 6% on 6% of those gains. The only reason now this is important, folks, the only reason not to book a material loss, is if you have a strong conviction that a particular stock will go up more than 20% in 30 days. If you aren't convinced that it's going to go up more than 20% in 30 days, that's a long-term rate. If it's short-term loss, that's even better. In the next 30 days, you should book the loss because it will offset future gains and you will get a 20% benefit at some point, probably in that same year. Otherwise, you get a loss carry forward you can use in the following year. Folks, we don't make 20% a month in stocks. Every once in a while we'll get lucky, but we don't make 20% in stocks consistently. Nobody does. Okay? But if you book a loss, you are going to get that 20%. So there's no reason not to book a material loss. And if you are in a pie chart asset allocation strategy, which they were at Schwab over on the smart intelligent side, okay, it should always be done at year end. However, brokers don't like to talk about it. So instead of tax loss harvesting, they talk about averaging down. Folks, that's a sucker's play. If someone talks to you about averaging down, run. In any event, so-and-so intelligent portfolios should always be doing tax loss harvesting each year. Have they been doing that? If not, your mom's already paying too much in taxes for a lousy return. They're coming to us because our returns are a lot higher. Which leads me to my next question. Would you rather have less money and not pay the tax due to poor performance? Or would you rather have a tax bill and have more money accompanied with the tax bill? Similar to tax-free muni bonds, folks, muni bonds aren't tax-free. You're just paying the tax to the municipality in the form of a lower interest rate, a lower return. You're making less money. So whenever you're comparing bonds, you got to look at the tax equivalent, after-tax equivalent yield. You got to compare, you got to look at your marginal tax rate, gross up your muni rate, and then compare to a treasury bond or investment grade corporate, because they're a lot more liquid. Muni bonds aren't that liquid. They're only liquid in their state and a few states that don't have an income tax. That's their market. So California's got a pretty big market for muni bonds because California is a very populated state. Wyoming, not so much. There's not a demand for Wyoming muni bonds, so they're illiquid. So in a big squeeze, inflation or raising rates, you're going to get caught. You're not going to be able to get out. So again, which is better? Since the inception of Grotection, we've never, ever had a bear market. The S&P has had 3. It's a smoother ride with a easier equity curve. Now, that was a little long-winded. I just wanted to give her a complete answer, but that was a very, very good answer. I wanted to tell you about that. Okay. One last thing. This is from another client, JS, and he's a great guy. He doesn't really. He's been a client for a long, long time. He doesn't really follow Don on his videos. He came over from the pie chart asset allocation, and he's working hard. He's a rancher farmer. He doesn't really have time to watch the markets. He said, why again do you sell in one day, sell one day and buy again the next at a higher price? I do not understand the trading. Just asking. By the way, when do you move to Allen? We moved our offices. I said, the market is quite volatile, trying to find its footing after a nice run. In a stock we liked, the market began to sell off hard, so we sold. Stock stabilized after the Fed speak and or earnings, so we re-entered. We are very active with the downside protection. You're up. You're beating the S&P by over 1.5% this year. Now we will get some whipsaw sometimes, but you will not go through a 20 or 30% decline like the S&P. So that's why it's important. So folks, we always say it's okay to be wrong. It's not okay to stay wrong. When the market gets choppy, there will be a little more trading, and sometimes you'll get a little whipsaw. Sometimes you'll get out, and then you'll get back in. But that's because we're managing risk. Because if I don't mind having that conversation with a client, the conversation I'm not willing to have is, why did you let my stock drop 25, 30%? Folks, if you've got an advisor that's letting your individual stocks or your ETFs go down 30%, 25%, maybe it's time to rethink. Maybe there's a better way of doing things. Anyway, listen, have a great weekend. If you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. You can just tell them, hey, I follow these guys. I love it. Just watch it. They can put in their name and their email address. This podcast will be delivered to their inbox on Saturday morning when it goes out. And Don's daily market insight videos will go out every evening, the business day that the markets are open. Better yet, if you go to our YouTube channel, just Revere Asset, and subscribe, this podcast will be in your inbox by about 1 o'clock Friday afternoon while the market's still open. Our Stock Nerd community follows us on our YouTube channel. You can also email us by the way, there's a subscribe button on the website next to the Contact Us, and it sends me an email directly. You can ask about an individual stock, a topic you want talked about on the radio, or if you simply want a complimentary portfolio review. Folks, you can email any of us. You can email me at dan@revereasset.com, don@revereasset.com, or Ted or Connor at revereasset.com. And you can always call us old school at 855-REAL-WEALTH. We'll talk to you next week on Your Money. Not their money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.